Welcome back, traders and investors. We have Tobias Carlisle on the line. He's a principal at Eyquem Investment Management. He's wrote a book, Deep Value: Why Activist Investors and Other Contrarians Battle for Control of Losing Corporations. Tobias, how are you doing today?
Very well, thank you. Good morning.
Could you tell us a little bit about your firm?
So the fund is very deep value, and we hedge with volatility.
Okay. And so you wrote this book here, Why Activist Investors and Other Contrarians Batter for Control of Losing Corporations. What inspired you to write this book?
I published a book in 2012 called Quantitative Value, and one of the findings in that book was that very deep value companies without any sort of quality measures like a return on invested capital, return on equity, return on asset type quality measure tended to outperform those that had these quality measures in them. So if you broke a group of these companies into two, and you had one was high quality and one was sort of no quality, the no quality tended to outperform the high quality. And that was one of the things that I got the most questions about from people who had read the book. So I thought I'd write another book that described the reasons why deep value, low quality or no quality companies tended to outperform high quality companies.
Okay, so you talk about activist investors here and other contrarians battling for control, losing corporations. It seems to me a lot of these activists, I mean, if you go to like Icon or Ackman, I mean, they're really, I mean, if you give the Icon example here, going, Apple and a lot of the companies that he goes after, I wouldn't exactly classify them as losing corporations.
Well, you remember he was trying to bust up the Dell deal, and Scott Wapner at one of the CNBC conferences asked him, why are you going after this company when, you don't want to be in this sort of business, do you? This is a dying business. And he said, I'm a Graham and Dodd investor, and if you look at my track record, I've always gone in when these businesses are dying, and a lot of analysts miss this stuff. So I think there's a lot of concern about Apple's business, whether they're able to survive selling phones when there's so much more competition out there now. It doesn't necessarily mean just a company that has declining earnings. Sometimes it's a company in crisis, and I think Apple was one of those opportunities where the stock price was down so much, there was some concern about whether the business would continue to grow because it was so large, and whether the competition would just sort of erode those huge margins that they'd been enjoying. But if you ran a screen of all of the big companies in the US at the time, Apple was the most undervalued company on that list. And I think it's sort of under $400. It was a screaming buy. I think still now you can find guys out there who think it's a short, even though it's still very undervalued. And it's up back to almost all-time highs or beyond.
Yeah, it did. So I'm actually that's a good point. That's when Carl did get involved in it. So what's your take on Apple now? I mean, it definitely is. Icon nailed it. Got picked up
Yeah.
the stock, and now it's come back and rallied back to new all-time highs. A lot of brouhaha over the new products. Do you still think it's a overvalued or undervalued company?
It's undervalued. It kills me to say that because it doesn't feel right to say it after it's run up so much, and it was such screaming good value at sort of 385 or whatever it bottomed at.
Yep.
But you remember Einhorn and Icahn were both in there trying to get them to pay out that $150 billion in cash that they had sitting on their balance sheet, and over the course of the last 6 to 12 months. They've conducted that enormous buyback. I think it's the largest by dollar volume ever in the US or in the world. So it's a much different company than it was 6 to 12 months ago, but it's still undervalued on a number of different value metrics. It could be sort of in the cheapest 10 to 15% in the market.
Okay, so based on your analysis and the stuff that you wrote in the book here, big run up in the market, are there any companies out there that would kind of fit the Apple scenario of what was that late of last year, or 2012 and 2013? Are there any companies out there that are undervalued that active investors or contrarians are battling for or will battle in the near future?
So that I think that Apple was an unusually good opportunity, but there are some interesting things out there that bear taking a closer look at. One is CF Industries. The ticker's CF. It's a fertilizer manufacturer. It's got a market capitalization of about $12 billion. It's got $5 billion in debt against about $2 billion in cash, which means that it's got an enterprise value of about $15 billion. And it's doing about $2.5 billion in EBITDA, which gives it a acquirer's multiple, which is the metric I talk about in the book, which is sort of, your listeners might be familiar with the enterprise multiple. This is just a variation on it that sort of teases out the things that are more interesting to activists and private equity firms, LBO firms. So it's trading on about 6.7 times acquirer's multiple, which is cheap for a big company, generating about $1.5 billion in cash flow. The thing that makes it interesting is they're actually buying back stock. So they've bought back about 14% of the market cap over the last 12 months, still paying a little dividend. So they've got this, they've done some of the things that you might want activists or leverage buyout firms to do and come in and do those things, but the stock hasn't really moved. So I think it's still sort of interesting where it is now.
Okay. Any other issues that fit that mode besides CF Industries that you can think of?
So if you're looking for a wild ride, this
Yes.
one could be interesting.
Okay.
Coach, it's a luxury retailer. It's one of the ones that makes you sick if you're trying to buy it in this sort of environment. But sometimes I think that that's a good indicator that it might be a good idea. So they sell these handbags in retail malls. They've had some missteps. Sales are down a little bit. Margins are down. So earnings are just getting crushed. Market capitalization is about $10 billion. Enterprise value is about the same. It's got EBITDA of about $1.4 billion, which means it's trading on an acquirer's multiple of about 6, which is cheap. It's got $1 billion in cash and cash flow, basically no debt. But the thing that makes it interesting is that these sort of constant missteps by management mean that I think that management could be a little bit vulnerable. So if an activist or private equity firms come in, they can pay a premium, and maybe there's a little catalyst in its future.
The acquirer's multiple, is that something that is a familiar term? Is that something that you came up with, or and that just implies what if the company was going to be taken over? You said like 6 was a low acquirer's multiple. What would be an example of a high acquirer multiple?
It's going to vary from company to company. The acquirer's multiple is a variation of the enterprise multiple, and the reason that I like the enterprise multiple. So, if you're not familiar with that, it's the enterprise value is market capitalization, netting out the debt and adding back in. Sorry, netting out the cash and adding back in the debt and any sort of off-balance sheet liabilities. And the reason that is a useful metric to big acquirers is they can get control of the entirety of the company, and then they can change the mix of debt and equity in there to suit themselves. So what they typically look for is a cash-rich balance sheet, strong operating earnings in relation to the business. And so it's the sort of thing, it's like, you can think of it like an industrial strength PE multiple. So there's no real what multiple is the right multiple or what is the wrong multiple. That's going to vary from company to company, but on average you can sort of think of 10 as being fully valued. And so I think that anything at sort of a big enough discount to 10, 5 or 6 times, there's a little bit of room for someone to come in and bid 8 or 9 times, leaves a little bit on the table for them. So I think that if you can find stuff at 5 or 6 times, you can do okay buying at that level. The problem with a market like this is there's not a lot around at that sort of level, and the stuff that is around is a scary type business. it's going to be a coach type business.
Okay, and what do you do like when the activists square off? Like in the case of Herbalife,
Yeah.
that yeah, they know you have Ackman on one end thinking the company's going out of business, and you have Icon on the other. For a long period of time, Carl really had him on the run, but looks like Ackman here is back in the money. What do you do when the activists square off like that? You just stay out?
No, not at all. For me, that was a fairly easy decision because Herbalife was in my in my model. It was one of the cheapest companies in the model. And for me, that's an easy decision to buy. Um, you wind forward 12 months and it's no longer in the screen. So there are other better opportunities. So that's an easy decision to sort of no longer be holding or to sell it. Um, I don't. One of the things that I talk about in the book is that it's very difficult to sort of see prospectively what a business is going to do. So you don't want to be too worried if it looks like it's been beaten up, and you don't want to be too excited if it looks like it's going very well. I think the multiple is kind of the most important thing, and you buy it and you think about it like a portfolio. Some are going to work out, some aren't going to work out, and the ones that do work out are going to go very well, and the ones that don't work out, you're not going to lose that much on because they're already pretty undervalued. So that's sort of an asymmetric type opportunity where you go up a lot more than you go down. Herbalife was one of those ones that it was a battleground stock for quite a while. Two big guys who are super, super smart on both sides of that trade. But for me, it was an easy decision. It was a long, and now it's no longer a long.
Okay, we've had Tobias Carlisle on the line. He's a principal at Eyquem Investment Management. He has written the book Deep Value, Why Activist Investors and Other Contrarians Battle for Control of Losing Corporations. Made a great example on the Apple scenario when Carl Icahn got involved. Tobias, thanks for coming on. We appreciate your input, and we hope to talk to you again.
Thank you, sir.